The week of June 14, 21, 2025 was marked by heightened volatility driven by geopolitical risks, central bank policies, and mixed economic signals. While US and Indian markets showed resilience with periodic rebounds, concerns over oil supply disruptions and inflation kept investors on edge. As markets head into the final week of June, focus will shift to upcoming economic data, corporate earnings, and ongoing global developments. Staying informed and adaptable will be key for investors navigating this dynamic landscape. So after a week of pure carnage, where do we go from here? And more importantly, what should you, the retail investor, be doing? First, let's look at the other moving parts. In the corporate world, there were a few stories that got drowned out by the macro noise but are still important. In India, the BSE Sensex gained 677.55 points to close at 81,796.15 on June 16, and the Nifty 50 rose K.92% to 24,946.5, fueled by value buying and a global rally. Industrial and IT names took a beating with declining stock charts and red arrows down. In India, Nestlé India gained over 2% due to strong Q4 performance. United Spirits acquired NAO Spirits for 130 rupees 0 pice crore, and Suzlon Energy secured a 170 MW wind order, boosting its stock by 3%. HDB Financial Services announced its IPO opening on June 25, and Keynes Technology set a floor price of 5,625 rupees 75 paise per share to raise 1,600 rupees 0 paise crore via qualified institutional placement. Globally, the communications and high-tech sector saw 14.5% revenue growth driven by AI advancements, while transportation revenues dipped 2.6%. India's AI sector continued its rapid growth, with a market projected to exceed $17 billion 0 cents by 2027, not just because of the market-wide panic, but on concerns that a global slowdown and higher energy costs would hit their earnings hard. In the US, on June 13, the S&P 500 fell 1.13% to 5,976.97. The Dow Jones dropped 1.79% and the Nasdaq declined 1.3% amid the Israel-Iran conflict. But by June 17th, the Dow rebounded 0.75% to 42,515.09. The S&P 500 rose 0.94% to 6,033.11, and the Nasdaq surged 1.52% to 19,701.21 after a U.S China tariff reprieve unsurprisingly had a great week. In the US, Intel announced leadership changes on June 18 to refocus on engineering following layoffs of over 21,000 employees in April. The communication services sector led S&P 500 earnings growth, while financials and healthcare also reported strong gains. When missiles fly, companies that make them tend to do well. In the currency and bond markets, the Indian rupee beaconed to 86.09 against the US dollar, while the US 10-year treasury yield remained steady at 4.21%. It was a classic flight to safety. The US dollar, the world's ultimate reserve currency, strengthened against almost everything else. India's new 10-year benchmark GOI 6.33 2035 traded between 6.24% and 6.33%, closing at 623.29, 96% there. The national average money market account rate in the US stood at 0.62%, with top accounts offering up to 4.41% APY. The Japanese yen and Swiss franc also saw inflows for the same reason. Meanwhile, in the bond market, US Treasury prices rallied, pushing yields down as investors dumped stocks and sought the perceived safety of government debt. This is textbook risk-off behavior, that it prefers the guaranteed return of capital over the potential for a return on capital. But making rash decisions in a volatile market, selling everything now just locks in your losses. If your time horizon is long, and for most of you it should be, these kinds of pullbacks are part of the game. The world has been through geopolitical crises before, and markets have always recovered. My advice, stay disciplined. Review your portfolio. Do you own high quality companies with strong balance sheets that can weather a storm? Good. Are you diversified across different asset classes? Even better. This is a time for caution, not for fear. Keep your eyes glued to the price of oil and any news coming out of the Middle East. That is the single biggest driver of this market right now. Have some cash on the sidelines, ready to deploy when the dust settles. There will be incredible bargains when the fear subsides. But for now, buckle up, it's going to be a bumpy ride. Now let's talk about the people in suits who are supposed to keep the economy on an even keel, the central bankers. This week they were staring into the abyss. The U.S. Federal Reserve maintained the federal funds rate at 4.25%, 4.50% for the fourth consecutive meeting on June 18th, with Chair Jerome Powell reiterating a wait-and-see approach. And they were in a tough spot. They did what everyone expected and held interest rates steady in their 4.25 to 4.5% range. But honestly, the real story was in their projections. They still signaled that 2 rate cuts might happen by the end of 2025, but they dialed back their expectations for cuts further down the road. Why? Because the war in the Middle East is a massive wild card. Higher energy prices could reignite inflation, forcing the Fed to keep rates higher for longer, or even, dare I say it, hike them again. The European Central Bank signaled a potential pause in rate cuts, while the Swiss National Bank unexpectedly slashed rates to zero, adding to market volatility, is in an even worse position. Europe is far more vulnerable to an energy price shock than the United States. The ECB has been trying to gently guide the Eurozone economy to a soft landing, but a sustained oil price of over $100 a barrel would blow that plan to smithereens. It would mean higher inflation and a near certain recession. The pressure on ECB President Christine Lagarde is immense. Does she fight inflation by keeping rates high, thereby crushing the economy? Or does she cut rates to support growth and risk letting inflation get out of control? Meanwhile, other central banks were also scrambling. The Swiss National Bank, which has been more aggressive in cutting rates, is probably regretting that move now. The Bank of Japan held rates steady at 0.5%, reflecting caution amid trade uncertainties. The Japanese yen appreciated 0.21% to 144.43 against the dollar. As a safe haven currency, which is terrible news for its export-driven economy, the Reserve Bank of India tightened project finance norms for banks and NBFCs, impacting the financial sector. India's liquidity absorption peaked at R3.21 lakh crore on June 6th, and the money supply M3 stood at R279.34 lakh crore as of May 30th, up 9.4% year-on-year, is looking at the price of crude oil with absolute dread. A surge in oil prices widens India's current account deficit and fuels domestic inflation, tying the RBI's hands. Every single central banker, from Washington to Tokyo, had their playbook torn to shreds this week. Geopolitics just trumped economics, big time. The bottom line is that investor confidence in central banks took a big hit. For the past year, the narrative has been simple. Inflation is falling and rate cuts are coming. That narrative is now in serious doubt. The oil shock has introduced a new powerful inflationary force that central banks can't control with interest rates. Their tools are designed to manage demand, not to fix geopolitical supply shocks. This creates a huge amount of uncertainty about the future path of monetary policy. Investors are now questioning whether the cavalry is really coming to the rescue. If you want to know where the real action was this week, forget stocks. Look at commodities. This is where the geopolitical fear translated into pure explosive price action. Oil was the undisputed king of the chaos. U.S. crude oil prices surged by a massive 7.26% on Friday alone. U.S. crude oil futures surged 7% to $74.23 per barrel on June 13th after Israel's attacks, with prices fluctuating between 70 and 76 cents during the week. The global benchmark, Brent Crude, was right there with it, jumping 7% to about $74.23. These were the biggest single-day gains we've seen since the start of the Ukraine war back in 2022. For the month of June, Brent is now up a staggering 20%, fueled by the fear of a massive supply disruption. Why the insane spike? Because this conflict is happening in the world's most critical energy-producing region. Iran has repeatedly threatened to shut down the Strait of Hormuz, a narrow waterway through which a huge chunk of the world's oil passes every single day. If that choke point is closed, analysts are already whispering the magic number, $100 a barrel. Some are even saying it could go higher. The Israeli strikes on Iranian infrastructure, even if they didn't hit oil fields directly, showed that energy assets are now fair game in this conflict. That risk premium is now being priced into every barrel of oil, and it's happening fast. And where do people run when they're scared? They run to the oldest safe haven in the book, gold. Gold prices climbed 1.4% to $3,132.34 per ounce on June 14th, reflecting its safe haven appeal amid global uncertainty. Australian wheat futures strengthened due to weather concerns and Middle East tensions, with capital flows supporting price gains. Australia's lamb exports hit a record 360,000 tons in 2024, with 2025 exports up 2%, led by demand from the U.S, China, and Papua New Guinea. Natural gas futures on India's MCX rose 2.31% after Israel's attack on Iran's South Pars gas field disrupted production, raising supply concerns. Shining brightly as investors dumped risky assets like stocks, gold soared past key resistance levels as the demand for a store of value. It wasn't just about the Middle East. It was also about the fear that central banks are losing control. If their only answer to an oil shock is to print more money or to let inflation run wild, then holding physical gold or gold-backed assets starts to look like a very smart move. Gold doesn't care about earnings reports or interest rates, so you have this perfect storm in the commodity space. Oil is screaming higher on supply fears, threatening to wreck the global economy. Gold is soaring as investors flee to safety, signaling a massive loss of confidence in the system. Other commodities got pulled along for the ride, but the story was all about oil and gold. This dynamic is crucial. The surge in energy prices will feed directly into inflation numbers, making the job of central bankers a living nightmare and putting immense pressure on household budgets and corporate profit margins. When fear takes over, sellers come out in droves, and that's exactly what we saw in the stock markets this week. It was a sea of red from New York to Mumbai. In the US, the selling was relentless. The Dow Jones Industrial Average got hammered, dropping over 700 points, a nasty 1.79% slide, closing at 42,515.09 on June 17th. The S&P 500 fell 1.13% to 52976.97, and the tech-heavy Nasdaq dropped 1.30% to 19701.21. It was a sea of red from New York to Mumbai, out of equities and into safer assets. The VIX, the market's fear gauge, went through the roof. It was pure, unadulterated panic selling. Over in Europe, the story wasn't any prettier. The major bourses in London, Frankfurt, and Paris all took it on the chin. The FTSE 100, the DAX, and the CAC 40 all tumbled as the double whammy of war in the Middle East and the prospect of sustained high energy prices threatened to tip the continent's fragile economy back into recession. They all tumbled as the double whammy of war in the Middle East and the prospect of sustained high energy prices threatened to tip the continent's fragile economy back into recession. European companies are heavily dependent on imported energy, so a spike in oil is a direct hit to their bottom line. Every sector, from industrials to consumer discretionary investors, were dumping European stocks like a hot potato, worried about what a cold winter with $100 oil would look like. Let's hop over to Asia, where the reaction was just as swift and brutal. India's Nifty 50 dropped 93.10 points to 24,853.40 on June 17th, and the Sensex fell 212.85 points to 81,083.30 after President Trump's comments on Iran. And Sensex, which had been enjoying a fantastic run, hit a wall of selling. Investors, both foreign and domestic, rushed for the exits. The prospect of a higher import bill for crude oil, India's Achilles heel, was enough to trigger a significant correction. In Japan, the Nikkei rose 0.8% on June 17th, but later plunged as global risk-off sentiment took hold. A stronger yen, seen as a safe haven currency, also hurt Japanese exporters, adding another layer of misery. From Hong Kong to Seoul, the picture was the same. Fear was the only game in town. What caused this global rout? The direct attacks on energy infrastructure were a game changer. This wasn't just posturing anymore, it was economic warfare. And when you throw in President Trump's comments about potential U.S. involvement, you have a recipe for a market meltdown. The algorithms that control so much of today's trading are programmed to sell on headlines like these, and they did so with ruthless efficiency. It was a week where the bears... That was the sound of global markets getting hit with a 1-2 punch this week, folks. One fist was geopolitical mayhem, the other was central bank confusion. And let me tell you, it was a knockout blow for the bulls. We started the week of June 14th with a powder keg already lit in the Middle East, and by Friday the 21st it had exploded. The conflict between Israel and Iran went from a simmer to a full-blown boil, and it sent shockwaves through every asset class you can think of. This wasn't some minor skirmish, this was the real deal, with major military actions that put the entire global energy supply at risk. It's the kind of black swan event that makes a mockery of all those neat and tidy analyst predictions. Let's get one thing straight. When missiles are flying, markets get terrified. And they were right to be scared. Israel launched what it called a large-scale attack wave right into the heart of Iran, targeting their nuclear program, causing severe damage to the Natanz facility, the crown jewel of Iran's nuclear ambitions, and a strike on the Arak heavy water reactor. This wasn't a warning shot, this was a direct, devastating blow. Iran, of course, didn't just sit there. They retaliated with Operation Severe Punishment, firing hundreds of missiles back at Israel. This is the stuff of nightmares for Wall Street, a direct tit for tat that spirals into something much, much bigger. Then, to pour petrol on the fire, you had President Trump in the US weighing his options. He came out and said he'd decide within 2 weeks whether to get the US military directly involved. The mere suggestion of American boots on the ground or jets in the sky sent another wave of panic through the trading floors. Trump wants a real end to Iran's nuclear program, and the market heard that loud and clear. It means this uncertainty isn't going away anytime soon. It's a sword of Damocles hanging over the market, and investors despise that kind of unknown. So you've got this massive geopolitical crisis unfolding, and at the same time you have the world's central bankers trying to figure out what on earth to do. Their job of taming inflation just got 1 billion times harder. Higher oil prices mean higher inflation, which means the rate cuts everyone was banking on might just go up in smoke. It's a classic stagflationary shock where you get slower growth and higher prices. This is the worst case scenario for the Federal Reserve, for the European Central Bank, for every single policymaker out there, and their decisions this week only added to the market's dizzying spin cycle. As we look ahead to the final week of June, the dust from this week's chaos is far from settled. Volatility has become the new normal, with every headline carrying the potential to swing markets in either direction. While US and Indian indices managed to claw back some losses, the underlying anxiety remains, fueled by fears of further oil supply shocks and a stubborn inflation outlook. Investors now turn their attention to a fresh round of economic data and corporate earnings, searching for any sign of stability amid the storm. Central banks, meanwhile, are walking a tightrope, balancing the need to control inflation against the risk of stifling already fragile growth. The message is clear: in times like these, staying informed and agile isn't just a strategy, it's a necessity. As global events continue to unfold, only those who adapt quickly and keep a cool head will be able to navigate the unpredictable waters ahead. The next chapter is unwritten, and for investors, the story is far from over.